Hello everyone. Welcome to A-Level webinar series organized by Mission Cordoba of Muslim Majlis of University of Sri Jayawardhanapura. As scheduled, today we will be having the session for the brothers and sisters who will be sitting for the A-Level examination in English Medium Commerce stream. So this warm welcome is for ARM Wasim, undergraduate of University of Sri Jayawardhanapura, to continue the program.
Okay, a warm welcome for everyone who are here today to study an accounting chapter. Let's say, guys. So today we will be studying investment appraisal. It's an important chapter for your grade 13. So if there are any grade 12 students, it's okay. You can learn this. Okay. Okay, if there are any grade 12 students, it's okay, guys. You also can learn. But mostly I talk for grade 13 students who are gonna sit for exams this year. So first of all, so guys, please unmute yourself, and if you have any doubts after I explain a slide, I will ask from you guys, and then you can send your doubts in chat. Now after I forward that the message that I am planning to do this chapter, many of you guys sent me messages asking what is this chapter. Is it in accounts? Is it in accounts we have this chapter? They ask like that. For guys, mostly this is grade 13 last chapter, kind of last chapter. So you guys would have missed the online classes, or else you wouldn't have easily understood this. Guys, this is a part of management accounting. Accounts can be divided into two: financial accounting and management accounting. So this is a chapter in the management accounting. This is a chapter in management accounting. Okay, so let's start. Okay, another question most of you guys asked: is this chapter important? Is this chapter important? Or even when I taught this in school, they'll ask, is this important? Is this important as company accounts? Is this important as partnership? Because most of you all study hard at the financial accounting. Financial accounting side only you will study. Yeah, it's true, because 70 to 75% will be financial accounting. So 25% or 30% will be management accounting. So it's okay, you guys can study, but 30% is management accounting. So is this chapter important? Is this chapter important to study? Okay, you guys can decide. So you all can decide whether to study this chapter or not. How can we decide? Okay, by analyzing the past papers. So investment appraisal or investment decision chapter has been tested always, isn't it? A compulsory question. So guys, it is a compulsory question in your paper. 2021 paper it will be there. 2022 also it will be there. It is a compulsory question. Now this chapter will be taught in school before 2 months for your A-levels, before 2 months or 1.5 months. This is the easy chapter. This is a easy, very easy chapter in your management accounting, where you can score 10 marks. Mostly everything are 10 marks here, 10 marks, and then in MCQ also you will get 3 marks, 3 questions. So altogether we are looking at around 10 to 13 marks in your final paper. So guys, this is an important chapter. This is an important chapter for your A-levels. And is this hard? No guys, this is not hard. And do you need a double entry for this chapter? That's another question. Do you need double entry? Do Do you need to debit? Do you need to credit? Or do you need to draw T accounts, income statement, financial position? Nothing. Nothing. You don't need a double entry for this. You don't need. Okay. Okay. Why investment appraisal? Now these slides I have prepared short notes, like short notes. Okay. Only important things I have included here. Okay. So what's meant by investment appraisal? Now, guys, everyone know, right? Partnership accounts means we do accounts for a partnership business company accounts, and then a cash book, a general journal. So there should be a reason why we need to study this. Why investment appraisal? What's the reason? Okay, this is how simple points. This is how the business decides to invest in a long-term investment decision. A long-term investment decision considering all the cash inflows and cash outflows relevant to the project. So throughout the presentation, I would have highlighted some important points in yellow. So those are really important key points. Okay, key points of the slide. So investment appraisal is kind of a technique done to assess whether the long-term investment decisions are good or bad. That's all. Is it good to invest or not? Is it good to invest or not? That is what we are going to decide here. That is what we are going to decide here. Now, if a company is going to invest on a land worth rupees 100 million, the value of land is 100 million. So that is a long-term investment, isn't it? So the business should consider whether I should purchase this land or not. So the technique used is investment appraisal, investment decision. Investment appraisal is done to make investment decisions. Okay, so that is the a very simple example, a very simple definition. Okay, and the first point, the decision of a company to invest in long-term project is called an investment decision. Company expects monetary rewards within the investment years. And then few examples. Okay, what are the examples? Let's say decreasing the labor cost per hour by introducing a modern machine. I'll explain. Now, think you are working in a factory, in a garment factory. Rather than using labors, you can import a machine which is 10 million. 10 million means 1 crore, okay? 10 million. So you can import a machine worth 10 million to do the same job, which takes 20 employees to do. So that is a long-term investment, because if you purchase a machine, you will expect to use it for more than 1 year. That means probably 5 years or 10 years. So that's why we do this investment appraisal. Before purchasing a project, you assess. Like guys, you do for an example, before doing a market survey. Now, before doing a research, you should do a market survey to study about the market. Same concept here. Before purchasing the machine, you should consider what are the monetary results, monetary rewards of this project. Monetary reward means cash inflows and cash outflows. What are the cash inflows and cash outflows of the machine? If I invest, what are the income I will get? What are the expenses I need to incur to do this? Okay, and then second example, increasing the sales of the book printing. Okay, by purchasing a multitasking printer. Okay, a multitasking printer means you can scan, you can fax, you can photocopy everything. So it's something like that. So a normal printer and a multitasking printer is expensive compared to the value. Multitask printer is expensive. Okay, let's learn practical now. Let's be practical, an example. Now you have done your O levels. Okay, after your O levels, your parents would give you a mobile phone. Now they wouldn't give, but you will ask it. Okay, I need a mobile phone now. Okay, because after O levels somehow they will buy give, you know. Okay, now and the budget is rupees 30,000. Your dad gives. Okay, here is rupees 30,000. You select and buy the mobile phone. Isn't it? Now for girls, I don't know, but boys, of course, it's like that now. Dad will give the money, and then we must go and purchase something. Okay, so let's say my dad is giving me 30,000 to purchase a mobile phone. Okay, and apply to yourself. Okay, so what's the first thing I will do if I wanna purchase a mobile phone? What are the basic things I will do? First, I will compare the price. Okay, first of all, I need to look into the price, right? Because my budget is 30,000. I cannot purchase a mobile phone which is 40,000 or 50,000. Budget is 30,000. So price should be equal to 30,000. Okay, should be equal to 30,000. And then I will consider the brand. Okay, the brand of the mobile phone which I'm gonna buy. Is it a Samsung, iPhone, or Huawei, Nokia, Vivo, Oppo? There's a lot now. So now I will consider all the brands in the market, and then I will consider specifications. Okay, what is the camera quality, the display, and then the software, the battery, the design. I will look into that, and then the release year. That means is it a latest phone? Is it a 2021 phone, or is it a 2020 mobile phone? So I will consider that, and then I'll I'll definitely look into the color, isn't it? Now actually, guys, I want buy a I want buy mobile phone which is pink color or blue color, isn't it? Most probably I'll go for dark color. Okay, then color, and then the resale value. So this is important, right? If I so so before purchasing the mobile phone, I will think, okay, if I buy now, after 2 years, how much can I sell it for? So if you have a iPhone, you have a better resale value. If you have a Oppo, you won't have. So it's something kind of like that. And then the durability. I will consider, okay, if I purchase this phone, can I use it for 5 years or 4 years? Because guys, after all levels, we know this will be the phone that I'll be using for the next 5 years until I get into a job, and then after that, if I can buy thing, because right? So think, guys, think on your for accounts class, you should be very practical. For management accounting, you should have practical thinking. Now, for same for business studies, you should have logical explanation. Same here. So think, guys, in our daily life, for this rupees 30,000, which is compared very low. Okay, for 30,000 and for purchasing a mobile phone, just consider, guys, for how many things we are considering: the price, the brand, the color, the durability, everything. Because, guys, we are going to use it at the end, isn't it? At the end, we are going to use it, and then we are expected to use it for longer period of time. So if I am gonna purchase for this 30,000, think about a practical company which is going to invest 10 million, or guys 50 million in a machinery. Think about 50 million investment on a machinery the company is going to invest. So then, guys, for how long? That means they should consider their investment decision very serious, isn't it? They shouldn't make any mistake. They should make the correct investment decision for their business. So, so that's why the technique used is investment appraisal. Through investment appraisal only, guys, a company will decide whether to invest or not. So that's what we are going to learn now. That's what we are going to learn. That is a simple gist. That's all. The very summary of this chapter. Then the next slide. Okay, characteristics of long-term decisions. Now I have from start I've been explaining that investment appraisal is done for long-term decisions. Okay, what are the characteristics? There are some attributes for this. Okay, expected scale of investment is large, huge investment. Long-term decisions includes a very high monetary value, like more than guess 10 million or 20 million. Now think if I am running a, let's say airways company. I am running an airways company, and now I need to purchase a passenger aeroplane. So a passenger aeroplane costs about how much, guys? I don't know. Now I'm assuming around let's say hypothetical, right? 1 million US dollars. All right, guys, 1 million US dollars. So 1 million US dollars for Sri Lankan company is a very huge investment. Let's say Sri Lankan Airways is gonna purchase a aeroplane for 1 million US dollars. So they should consider, is it a brand new, or then what is the durability, how many passengers can it fit? So huge investment. That's what we are going to learn now. Okay, and then risk due to long term. Risk due to long term. This is a very important factor of long term decisions. Now let's say you are going to purchase a land. You're going to purchase a land in Ratnapura. Okay, you are going to purchase a land in Ratnapura and build your house. So it's a long-term decision, right? Purchasing a land and building a house, because you'll be staying there for around 20 or 30 years until for your rest of your life you'll be there. So you purchase and you spend 2 to 3 crores to build a luxury house, and then you are there, and then it rains on the monsoon season. It rains. What will happen? Floods. Okay, floods and landslides. Okay, floods and due to that, guys, your house is damaged now. Project is damaged. Your investment project is damaged. So it is a risk. It is a risk connected to long-term investment. Something like, and then third one, decisions are unchangeable. After you have built your house, guys, you cannot change it. A wrong decision cannot be changed. Funds are necessary throughout the long term. You need money to maintain your house or to renovate on a annually. You need to renovate, you need to maintain, so something like that. And this is the last one, the highlighted is really important, because we learn accounts on the business perspective. Okay, on the business perspective we learn. So as the shareholders funds are used for investment purposes, the best alternative decision should be chosen considering all the relevant cash flows. If I am the business, whose money am I going to invest in a project? Not mine, not the banks, nothing. I am going to invest the shareholders, the owners' money. The business is going to invest using shareholders' money. So the business should be responsible for making good decisions. It should be very responsible, because the business is handling their owners' money. So if the business is going to make an investment decision, it should be done considering all the relevant factors. Okay, what is mean by cash flows? I am saying considering all the relevant cash flows. The last sentence, considering all the relevant cash flows. That means cash flows means, guys, cash inflows and cash outflows. Cash inflows and cash outflows. We will learn what are the cash inflows, cash outflows in the next slides. We will learn. So now have an idea. If I say cash flow, it includes both. Okay, if I say cash flow, it includes both cash inflows and cash outflows. Okay, and the next slide. And there are some assumptions. Now, what we are learning in A levels is not real accounts. Okay, what we are learning in advanced level is not real accounts. Everything is based on assumptions. Now, even if I want to be honest, even this investment appraisal, we don't consider assumptions, right? Now there are some assumptions. Now why do we keep assumptions? To make this chapter easy. That's why we did the syllabus. But in real life, we don't have these assumptions. Okay. Initial cost should be made immediately. The first one. Initial cost should be made immediately means should be incurred immediately. Should be paid immediately. Initial cost. Now, if I am going to purchase an aeroplane, I should pay the whole amount. I should pay the $1 million US today, right now. Okay, immediately. That means today. Now in practical life, it won't happen like that, right? We will obtain a bank loan and pay that bank loan for 5 years. We pay through the bank loan. We obtain a bank loan and pay for it. And then we repay the bank loan for 5 years or 10 years. Mostly it happens like this. But here we assume that I make the total investment today. I make the total investment today. Second one, cash flows during the year incurred only at the end of year. During the year incurred only at the end of the year. Now, actually, guys, to be honest, if you are listening this for the first time, you'll be confused. Oh, you'll be confused what I am saying here. Cash flows during the year incurred only at the end of the year. What's meant by that means we assume, right? Assumptions. We assume during the lifetime of the project, after I purchase the aeroplane, if I am making any renovations or if I am maintaining it, the fuel cost, everything for the whole year, we assume for the whole year, everything is paid at the year end. We assume like that. From January to December, all the cost or all the cash flows include cash inflows and cash outflows. All the cash flows during the year, we assume will occur at the end of the year. End of the year means December 31st. We assume it occurs at the year end. Assumptions, okay? Assumptions. And then cash flows at the beginning of the year incurred at the end of previous year. So you guys read it, then you will understand. Cash flows at the beginning of the year is incurred at the end of previous year. Now, if you understand the second assumption, you will easily understand the third one. Now, in the second assumption, I said we consider all the cash flows occur at the end of year. Now, in the third assumption, I am saying cash flows occur at the beginning of the year, incurred at the previous year. Now, this year's year end is, now this year's 31st is next year's opening, right? So we consider like that. We consider like this, okay? Now, guys, these assumptions, they won't ask in the exam. So don't by heart it. Don't now. If I say to by heart, then do that. Okay, then write it on your paper. Everything. These are not really important. Okay, you need to understand these are assumptions that are these are of knowledge. Okay, theory knowledge. That's all. That's why I have included. And then fourth one, the last one, working capital is invested immediately, and at the end of the project, it will be recovered. And now, only understand, working capital is invested immediately, and the invested amount will be recovered at the end of the project. At the end of the project. Working capital. Okay, what's meant by working capital? Working capital equals the equation inventory, that means normally current assets minus trade payables. Current assets minus trade payables will give you working capital. Now these are the assumptions you should have in your head, but don't by heart. Don't even bother studying this over and over. Just look one or two times, that's all. Go through twice maximum. Okay, important factors when considering cash flows. Now the heading is different. Now we are learning factors related to cash flows. If I want to go to the previous heading is in cash flow estimation. Okay, now we are going to learn cash flows. Now these are also maximum go through twice. Okay, not more, twice. Consider after tax cash flows. Now from the start of the slide, I am saying, guys, now we have a investment duration project, right? If I invest in a project until for the lifetime, I need to spend for the renovation, something like that. So for the cash flows, we consider after tax cash flows. And second one, only the incremental cash flows are considered. Only the incremental cash flows are considered. It means not the existing cash flows, the cash flows which are increased due to investment considered here. Okay, I will explain this point with a question. Okay, I will explain this point with a question while learning past papers. I will explain very easy chapter. These are with theory, so don't get thrown off by that. This is a very easy subject which you can do within 5 minutes or 10 minutes, guys. That's all. You can easy 10 marks. Easy than very easy than partnership. Very easy than, let's say, accounting equation. So easy, guys. Easy than accounting equation. Okay. And then third one includes all the cash flows happen due to indirect effects to the investment. Don't consider that point. Okay, just leave it if you don't understand. Fourth one is really important. Fourth one, sunk cost. The cost which has already incurred is not considered as a cash flow. It's not considered as a cash flow. For an example, I need to buy a house. Now it is my investment decision. Now the house is at, let's say Nigambu. Okay, now I am in Colombo, and now I need to buy a house at Nigambu. So the travel expenses which should be borne, which would be compulsorily incurred to travel back and forth from Colombo to Nigambu to inspect the house, isn't it? To inspect the house, you need to go there. Those expenses, the traveling expenses, or the expenses that should be incurred compulsory, we don't consider it in the investment decision. Sunk cost we don't consider in the investment decision. Interest is not included in cash flows. We don't consider interest. That means bank loan interest we don't consider. The last point also really important. Depreciation and non-cash expenses are not considered as cash flows. Now here we are specifically saying we only look at cash flows. So depreciation is not a cash related transaction. So we don't consider the depreciation for that year. I mean, depreciations are not considered. And then non-cash expenses like bad debt or something like that, let's say like stop loss, we don't consider it as cash flows. Mainly, most important, they will check your depreciation. They will check depreciation. They will give you depreciation, and they will check whether you will deduct or not. Okay, so you need to read the question very carefully, and if depreciation is included in the cash flow, you need to deduct it. If depreciation is included in the cash flows, you need to deduct it. We will learn the explanation. Year zero. Now, now I was saying, right, projects. So this is what we are going to do now. Year zero. Year zero means initial investment cash flow, which is today. Okay, now let's say, guys, if I buy a, let's say, if you are buying a laptop, so you will ask the shop owner or the one who is selling you, okay, how many years can I use? So he will say, no, it depends on yourself. If you are using only for Word, and then for minimal effort and not for gaming or hard use, if you are using it softly, you can use it for 4 years without any problem. So he will say you 4 years you can use it without problem. So guys, that 4 years is the lifetime of your laptop. So it is like, guys, the project life, the investment life. So that only we consider here. Year zero means today, initial investment. Okay, year zero means today. And then annual operating cash flows. Year one, year two, year three, year four. Then now let's say I am going to buy a printer for my bookshop. The value of the printer is 600,000. 600,000 a printer. Now the useful life is 5 years. That means the investment, the project life is 5 years. So I can use my investment only up to 5 years. So that's what I'm saying here. Annual operating cash flows. Annual operating cash flows means until you use the project, until you use the investment, the cash flows you need to incur, the cash flows generated. Year zero means cash flows you generate at the year start. That means today. And then the second one is annual operating cash flows. Annual operating cash flows means, guys, the cash flows which is required throughout the project lifetime. And then terminal cash flow, the year in which project ends. Now, if I am the example, if I am going to purchase a printer and the useful life is 5 years, the year zero is there. Year zero, after year zero only, year one. Okay, so year zero is today. Year zero means today. So year zero, and then annual operating cash flows will be until year 5, from year 1, 2, 3, 4, 5. Year 5 will be annual operating cash flows. And terminal cash flow, the year in which project ends, in which year what is the useful lifetime of project, my printer? 5 years. So the terminal cash flow is the year in which project ends is 5th year. Now we will learn the examples for this. Now you need to know that. So from here you need to really concentrate, and then I will explain slowly. I will explain once or twice. You guys will easily understand. Number one. Number one, initial investment cash flows. Initial investment cash flows. Okay. Cash flows required at the start of the investment. I have prepared this slide very summarized in very simple English, which everyone can understand. Okay. Cash flows required at the start of the investment, required at year zero. That means today, right? Now, if I am going to purchase a printer, what are the cash flows that I need to have? Let's say this is the format. Initial investment. Now you guys would have learned this in LKS 16. Property, plant and equipment. You have learned this to find the cost of the asset. Same thing here. Purchasing price, the new asset purchasing price, and then transportation and installation costs, and then initial working capital requirements. So you add everything. That is your cost. That means the cost of the new asset. And then let's say now I am going to buy a new printer. I have an existing printer, then I can sell it, right? So that's what the format has reduced. Minus cash received from selling the existing asset. Cash received from selling the existing asset. Okay. And then you will deduct the minus tax payable when selling the asset. You will deduct, and then initial net cash flow. If you see the last row, initial net cash flow will be in negative. Will be in negative because outflow. Initial net cash you need to pay, right? At year zero you need to pay, so it will be negative value, cash outflow. Year zero, that means cash flows. If I write in brackets, it is a cash outflow. If it is a positive amount, it is cash inflow, right? Normal, common sense. Okay, so initial net cash flow is negative amount. Why? Because you need to pay. So this is a very simple example. What are the cash flows you need at year zero? At year zero. Okay, example. Let's say an example. Why don't you calculate number one? Requirement number one. Take a pen and a paper, guys. I'll give you 2 minutes, guys, quickly. Read and then do requirement number 1 and 2. Requirement number 1 and 2. Requirement number 1 and 2. Okay. So hope you guys are doing. Let's say now. First of all, tell me, guys, did you think that now you need to ask the question yourself. Number one, you should have asked, have we bought this project? That means, have we bought the new machine? Have we? Send me answers, guys. Have we purchased the new machine? Have we or not? Is it before purchasing or after purchasing? Tell me. Is it before purchasing the new machine or after purchasing the new machine that we are going to do now? Now, guys, what we are studying, investment appraisal. Now, think. That's what you guys miss. That's what most of the students miss. We are doing this before purchasing the machine, isn't it? Before purchasing the machine only we are doing this. Now, think, guys, think practically. If you are going to purchase a new phone, what will you do? Same concept here. If I delete the words machine and then if I include the words phone, then say, do you do this sum before purchasing the new machine or after? This is done before. This is done before. This is done before purchasing. So requirement number one. So I have written the answers now. Okay. Calculate the cash inflow and cash outflow of initial investment. That means it is required to separately show what are the cash inflows and cash outflows. Okay, so you need to have two columns, cash inflows, cash outflows. Okay, cost of existing machine. Is it a cash inflow or a cash outflow? Send your answers. Cost of existing machine. Machine.
Nothing, sir, nothing.
Sorry. Send your answers, guys. Cost of existing machine. Cost of existing machine. Is it, what's that? Cost of existing machine? Good, good. Cost of existing machine, we don't consider now. The 250,000, we don't take, we don't account it. Okay, that is the purchase cost. Okay, the second row, purchasing price of new machine, 500,000. What's that? Cash inflow, cash outflow? Send your answers quickly. Cash inflow, cash outflow? Outflow. Good, good. Outflow. Okay. Installment cost of the new machine. Installment of the new machine. Good. Outflow. Expected sales price of existing machine, 100,000. What is that? Expected sales price of existing machine. What's that? Good. That is inflow. That is cash inflow. Okay, payable tax on the selling price of existing machine. Now, if you sell your existing machine for 100,000, you need to pay a tax of 20,000 for that. What is that? Payable tax on the selected, payable tax on the selling price of existing machine. What's that? 220,000. Now, a student has asked me, okay, now there is the word payable tax. Now, guys. Okay, now in accounts, guys, doing sums is not important. A student has asked, okay, now I have included payable tax. Okay, payable tax means is it a current liability? Is it a current liability? Now don't get carried by words. What I am saying here, payable tax the selling price of the existing machine. We are doing before purchasing the machine. If you are selling the existing machine, that's what we are doing now. Okay, so that is a cash outflow. And new working capital requirements. New working capital requirements, 75,000. What is that? What is that? Okay, so what is new working capital requirement? New working capital requirement. Is it an inflow or an outflow? New working capital requirement. Now this is where you guys get, yeah, most of the saying inflows and outflows. New working capital requirements are outflows. Working capital are outflows. Working capital are outflows. And this 75,000 will be recovered at the end of the year. Now, the last one, new working capital requirements. 75,000. If I want to go back, okay? Wait for a while. This one. Last assumption. Last assumption. Working capital is invested immediately, and at the end of the project, it will be recovered. So that's what I have written here. So now these are the examples of cash inflows and cash outflows. Good, cash inflows. And now guys, we are looking this example at year 0. Okay, year 0, that means today. If I decide to purchase the new machine, these are the cash inflows and cash outflows. Initial investment. Initial investment. Okay. Now requirement number 2. Calculate the net cash out. Calculate the net cash flow of initial investment. What is the answer? What is your answer? Quickly send me, guys. What's your answer? Send your answers, guys, quickly. Yeah. What's the answer, guys? What's the answer? What's the answer? What is the equation? There's an equation: cash inflow minus cash outflow. That's all. Cash inflow minus cash outflow. Then you will find the initial investment. What is the answer? 545,000 is the answer. 545,000. 545,000. It should be negative value. It should be negative, a negative value. Minus 545,000, indicating it is a cash outflow. Okay, students, if you have got it wrong, I'll explain again. Cost of existing machine, it is sunk cost. We don't take that 250,000. Purchasing price of new machine, it is a cash outflow. Purchasing price of new machine, cash outflow. Installment cost of new machine, cash outflow. Expected sales price of existing machine, cash inflow. Payable tax on the selling price of the existing machine, cash outflow. Net new working capital requirements, cash outflow. Cash outflow. If you deduct cash inflows minus cash outflows, you will get initial investment. 545,000 is the answer. 545,000 is the answer. Okay. So this is at year 0 today, right? Today. And now annual operating cash flows. Now we learned what are the cash flows associated with year 0. That means today. Today, if I want to invest. Now we are going to learn cash flows related to the project life. If I purchase a printer, the useful life is 5 years, right? So what are the cash flows related to that 5 years? Related to that useful lifetime. Number 1, there are the cash inflow. They are the cash inflows and cash outflows during the useful lifetime of the investment. So if you see the highlighted words, keywords, you will understand. During the useful lifetime of the investment by using it in the production process. What are the examples? Cash sales, cash received from debtors. Now, if I purchase a printer, I can print more copies and I can sell. So by purchasing a printer, my sales will increase. So this is a cash inflow. And cash received from debtors, cash inflow. And then cash purchases. Now let's say by using a printer, I need to maintain it. I need to use ink, printing ink. Okay, guys, sorry, there was a. Okay, can you, if you all can hear, please send a message. Yes, guys, can you hear? Okay. Okay, guys, sorry, there was a small technical problem because I lost my connection. That's all. So as I was saying, the printer I will be using for more than 1 year. So the useful life is 5 years. Then I should depreciate it. So there will be annual depreciation. You will record in your income statement depreciation. But will that depreciation amount be considered in these cash flows? Will it be considered in these cash flows? Depreciation is not considered. Remember that, okay? Most students go wrong in that. Remember, depreciation it is not considered. And we calculate the year 0, the annual operating cash flows, everything everything before investing. Investment appraisal, what we are learning is investment appraisal. I haven't purchased the printer yet. I haven't purchased the printer yet, but before purchasing, I am calculating everything. I am calculating the year zero, assuming. I am calculating the annual operating cash flows. I am assuming everything. Okay, before purchasing, and then terminal cash flows. Terminal cash flows means cash inflows and cash outflows at the end of the investment year, at the end of the investment project, the end of the investment project. What are the examples? There are only few examples, guys. There's only few examples. Very few examples. What are those? What are those? Residual value of the investment. Residual value means now after 5 years, I can sell my printer for a now if I purchase for 600,000, after 5 years I can sell that for 50,000. So that is residual value. So at the year end, it is a cash inflow, right? 5 terminal. At the year 5, it is a cash inflow. And then recovery of working capital. What you invested on year 0, you will get on the year 5. Year 5, that means the end of the project life. Okay. Now these things, these are theory. Accounts, you will very easily understand when you are doing sums. These are very easy sums, okay? Very easy sums. Very easy chapter to get 5 to 10 marks. And now from here onwards, it's really important. It's really important that you should be really concentrating. From here onwards only, we are going for the heart of this chapter. Now all this time I am saying that investment appraisal before purchasing a project, like that. But I didn't say how we are going to appraise a project, how we are going to decide, how we are going to decide whether to invest. What are the methods for investment appraisal? To make an investment decision, what are the methods? Now we are going to learn. And I need to say, you guys, just because I say this very easy, just because I say this is a very easy chapter, it doesn't mean learning today and tomorrow and then doing 3 questions. It's not like that. You need to practice. You need to practice. Now you will learn this very easy chapter. You will learn today and tomorrow, so Monday, then until Friday you will remember. After that you will forget. You need to keep this remember. So you need to practice. Just because it's easy, if you leave it, then at the end, at the final exam, within that 3 hours, you will mess up everything. You will miss the easy question, you will miss the hard question. At the end, you won't do anything because of that stress. Within 3 hours, you need to do a lot, right? Within 3 hours, you need to do a lot. So at that time, even an easy question, because you are not concentrating on the question, you are not reading it, you will make mistakes, and the easy question also will be hard for you. Easy question also will be really hard for you because you messed it up. You didn't know the technique, you didn't know the approach to do that question. Then there's a problem. You have the knowledge, but you don't know how to do the question. Okay, back to the chapters, guys. Now we are going to learn how to appraise investment. What are the methods? Very easy. There are 3 methods. Number 1, only 3. Number 1, payback period. Now these are the methods used to decide whether I should invest or not. Okay, whether I should invest or not. These are things. Payback period. Number 1, the first method. Second method, Accounting rate of return, ARR, accounting rate of return. Third method, net present value method. So these are the three methods which will be used, which we will be using. If you take all the past papers, only these three methods are tested. Payback period, ARR, net present value. And these are very easy, very easy chapters. Okay? Very easy chapters. Not chapters, very easy methods to calculate. There is a common feature among payback period and ARR. Payback period and ARR are non-discounted method. Non-discounted method means inflation rate is not considered. Inflation rate is not considered. But in net present value, inflation rate is considered. I'll give you 1 minute to read the slide. So, payback period and ARR do not consider inflation rate in their methods. But NPV consider inflation rate. Now, why inflation rate is important? Why? Why is that important? Now think. You guys think. You need to be very practical. There are students who are learning economics, right? Who are learning economics? Isn't it? Who are learning economics, then you would be learning inflation. Because guys, now as I explained, the characteristics of long-term decision, that's why I had that slide. If not, I wouldn't have included. The number one characteristic is long-term investment. A huge long-term investment which has a large sum for that. The investment amount is very huge. So wherever money matters, inflation rate is there. Wherever money matters, inflation rate is there, isn't it? Money. Now, if you are planning to purchase a mobile phone for 20,000 today, now for example, let's say for vehicles right now, for vehicles before 5 years, a three wheel was 400,000. A three wheel was 400,000. Before 5 years, the cost of a brand new three wheel was 400,000 before 5 years. Right now, do you have any guesses how much is that? Anyone? No, the boys would know that. Anyone, guys? Do you know a brand new 2020, not 2021, 2020, a three wheel cost? Anyone? Yes. Anyone? Send your answer, guys. Send your answer. 900. Some are saying 800,000, 900,000. Guys, it is 1.2 million. More than 1 million. 1.2 million, guys, a brand new 2020 three wheel. More than 1 million, a three wheel. But even not before 5 years, let's say before 3 years, a brand new three wheel wouldn't exceed more than 500,000. But now it is more than 1 million. A three wheel is more than one. Now if you don't believe me, after when you are free, rather than being in Facebook or Insta, you can go to ikman.lk and just type and see brand new. You can go to the vehicle section and write in the search vehicle, you can type in like brand new three wheel, or you can look into anything, even motor vehicle. Why guys? Why? What's the reason now? Now the number one thing is now they have imposed a ban. That's why the prices are high. Prices are high because they have imposed a ban. We can't import vehicles. Okay, but what's the reason for that? Why do they need to impose a ban? Because we are the not we are central bank is short dollars, US dollars, to pay the imports, to pay imports, hmm, to to pay the imports, you need to have US dollars. Okay, why US dollar is really important? Because it determines the value of our currency, value of our Sri Lankan rupee. Day by day, our Sri Lankan rupee deteriorates, not devalue, deteriorates against the dollar, against dollar. The value reduces day by day, day by day. Now, if you see what's happened to a general price of goods, general price of goods, same problem. Only boys know the price of all the goods, all the grocery stores things prices. Boys know, isn't it? So most of them know recently a 1 kilogram of sugar went for 220, 220, 210. But now it is 125 now. Now that was another scandal, another scam. But prices increase mainly due to inflation. Due to inflation. Only in Sri Lanka, prices increase to different reasons, but in developed countries, prices increase. Prices increase only for because of inflation. Okay, because of inflation. So think, guys, if you are going to purchase a land, which is more than a 30 million, 30 million, more than 3 crores. If you are going, if you are planning to buy that, you need to consider the inflation of the economy, inflation rate, the time value of money. We say time value of money in accounting terms. We say time value of money. Time value of money means after 2 years, because let's say a project, due to a project, an investment project, after 2 years, if I am getting 200,000, after 2 years, if I am receiving 200,000, what is the value of that 200,000 today? That is known as time value, because due to inflation. Now we will learn that very deep. That means a one slide or two slide while learning net present value. But right now have the idea, payback period and ARR, inflation rate is not considered. In NPV, we consider the inflation rate. Okay, now let's learn the number one, payback period, the first method, which is the easiest one. Not the ARR is easiest. This is the number two. Very easy. Payback period. Now the answer, the simple explanation is in the heading itself. Payback period. Payback period means, I'll explain the most simple way. If I invest 1,000 today, if I invest rupees 1,000 today, in how many years I can recover that? That is payback period. If I invest rupees 1,000 today, in how many years I can recover that? Payback period. Simply explained, payback period considers the time period in years and months to recover the invested amount. It is calculated based on annual net cash flows of the investment. Payback period means, guys, it calculates in how many years and months I can recover the initial investment I made. Initial investment I made. We have an example. Let's see. what is the decision criteria now? Okay, payback period, I said it's a method. What is the decision criteria? The project with the lowest payback period should be selected because the main objective is to recover the investment as soon as possible. As soon as possible. The project with the lowest payback period should be selected because the main objective is to recover the investment as soon as possible. Okay, now first of all, you guys would get confused. Normal. Let's learn through an example, then you will easily understand. Okay, how to calculate the payback period? How to calculate the payback period? Now, before that, guys, the decision criteria is really important. You need to remember that. For all the three methods, there are three decision criteria. Based on this criteria only, we decide whether to invest or not. So for payback period, how soon we can recover, it is good. How soon we can recover, it is good. Okay. How to calculate the payback period? Example number 1, straight for the example. If a company invests rupees 500,000 on a machine and annual net cash flows is rupees 100,000, in how many years the investment will be recovered? That's payback period. Guys, tell me now. Now you don't need to even calculate, right? Very easy. Now I am investing 500,000 today, and on an year, the question says on an yearly basis, I will receive net cash flow of 100,000. Then in how many years I will recover the initial investment? The answer is the slide I have given, right? The amount will be recovered in 5 years. Workings, investment divided by annual net cash flows equal the time period which I will receive, which I will recover the initial investment I made. Okay. Now, in this example, the annual net cash flows is constant, right? It is equal throughout the years. It's equal. What if it is different? What if the annual net cash flows you are receiving is different? Then how will you do? Now in this, the annual net cash flows is equal, same 100,000. So that you can easily divide. But if it is different, then example number 2. Example number 2. Now you need to take a pen and paper now. You need to have pen and paper, pen on paper, and then a company expects to purchase 2 machines. The net cash flows related to these 2 machines are as follows. Purchasing price of both machines is rupees 300,000. Okay, a company is deciding to purchase 2 machines, right? Machinery A and machinery B. The cost of both the machine is same. 300,000 is the cost. But from year 1 to year 5, they have given the annual cash flows. Okay, annual net cash flows they have given. Now what is the? Now you need to advise the business to purchase which machinery. Is it good to purchase machinery A or B? Now this is payback period. This is investment appraisal you are doing now. Now this is investment appraisal you are doing now. Decide on which machine to be purchased by calculating payback period. Okay, guys, you guys will. I'll give you 5 minutes. Not 5 minutes. 5 minutes. Give 5 minutes. Very easy. Learn payback period now. Very easy. The simple note is, how soon can I recover the 300,000? What I have invested, how soon can I recover? How soon can I recover? Okay, hope you guys got so many answers. Let's see. check your example. Okay, answer. So this is how you should have done. Now this is how I do for easy for your explanations. If you have any other method, it's fine, no problem. Okay, no problem. This is not the format. You don't need to follow this. You can use your own method. So this is how you should do. This is how you should have done for explanation. Now year zero outflow is 300,000, and then the third column is cumulative cash flow, right? Cumulative cash flow. Year one, you will get 80,000. That is positive. So 300,000 minus 80,000, negative 220. And then year two, you will get another 80,000. Then from that 220,000, I will deduct 80,000, and then you need to recover another 140,000 of that investment. Okay, you need to recover another 140,000. Now at the end of year three, you need to recover another 70,000 of your investment. 70,000 of your investment. And then at year four, okay, can everyone hear me? Is it fine? Can everyone hear me properly? Okay. Okay. And at year five, you will be receiving 60,000. Then it is positive 80,000, right? Now we don't need now we don't need the positive amounts. We only need to consider how early can I recover? How soon will I recover the 300,000? How early I will be recovering the 300,000? Okay, and the next one is for machine B. Machine A and machine B. So this is the answer. You'd have India. You should have done like this, not in the exact format, but understand. Now I am teaching that, thinking that you don't know this. That's why. And now you need to give the answer. Payback period of machine A is 3 years and 9 months. Payback period of machine B is 4 years and 3 months. Okay, what is the decision? Machine A should be selected as it has the lowest payback period. Okay, students who got this wrong, just look at where you went wrong, and remember, you need to write the decision. For that, you will get 1 or 2 marks. You need to write the decision. Comparing to, you need to do that. Decision, machine A should be selected as it has the lowest payback period. Now, when you consider machine A and machine B, if you purchase machine A, you will recover the 300,000 within 3 years and 9 months. Exactly at 3 years and 9 months, you will recover the 300,000. But if you purchase machine B, you will recover the total investment at year 4 years and 3 months. Exactly at 4 years and 3 months. Now, think practically, guys. You guys think which one you will select. You will select which one recovers the earliest. The earliest, right? The earliest is machine A. You will recover the 300,000 very early in machine A. So you need to purchase machine A, the decision, because it has the lowest payback period. Okay, now this is the end of payback period. If you have any doubts, just please ask me. If you have any doubts, please ask me, guys. If you have any doubts, please ask me. I'll explain. Because this is really important. This is really important. Now let's say wait. Guys, annual cash flows will be given. Now, if you see the example, sorry, if you see the question, guys, if you see this table, you can understand, right? Net cash flows I have given. Net cash flows for machinery A and machinery B. Read the heading, read the question very carefully. If you read the question very carefully, you will understand. Net cash flows are given in the question. Okay. There are some doubts. Let's see. Okay, how to calculate month? Now, most of you guys have. Sorry, wait for this. Okay. Wait. I will explain how to do it in months. How to do in months? Wait. I'll open the Excel. In Excel, I'll show you. Give me a minute. Okay, hope everyone can see my Excel, right? Okay, machine A. Sorry. Okay, machine A, machine B, cumulative cash flow, right? This is what I have done here. Okay, now. So for machine A, guys, for machine A, I will recover. Now I need to. So see in machine A, 3 years. So now at the end of 3 years, I need to recover only 70,000. At the end of 3 years, I need to recover only 70,000. But year 4, I am getting now at the end of year 3 now. Then at year 4, I am getting 90,000. I'm receiving 90,000, isn't it? I'm receiving 90,000, but I only require 70,000 to make it 0. It should be 0 here. To be 0 here, then it will be exactly 4 months. But it is 20. Then what should I do is, see guys, now I need to receive 70,000. See here, okay, see here, top, here. I need to receive 70,000. The annual net cash flow of the next year, year 4, is 90,000. Isn't it? 90,000 is for the whole year, for 12 months. Yeah. Okay. You see here, 70,000 only I require for the next year to make it 0. But next year I am getting 90,000. 90,000 is for the whole year, right? 90,000 is for the whole year. Then multiply by 12. And you will get 4 months. 70 divided by 90 into 12. Then you will get 9.33. You will get 9.33. This is how you will get the answer. Understood? Yes or no? Understood, guys? Yes or no? Students who had that doubt. What about others? Yes, Zaid, Abdul Rahman, Jezla, Umar, Divanya. Yes. Now these things you need to practice, right? These things you need to practice. Okay. So try to understand. That's why I have written 3 years and 9 months. Now decision. Now decision criteria, you need to write in your words a sentence, a 1 or 2 sentence. In a 1 sentence, you should write that. Machine A should be selected as it has a lowest payback. You should write that. You should mention it. You should mention why you are selecting machine A. Okay. This is in payback period. Now payback period is done. Now let's study advantages and disadvantages. This slide is important for your MCQ. In your part 1, for your part 1, you will get questions from this advantages and disadvantages of all 3 methods. There are 3 methods, right? Remember it now. Remember the 3 methods right now. Payback period, ARR, NPV, net present value. Payback period, ARR, NPV. Okay. Payback period done. We are learning advantages and disadvantages. Okay. Advantages. Easy to understand and calculate. Payback period is very easy to understand and calculate. And we only consider the cash flow of the project rather than the net profit. We only consider the net cash flow. We don't consider the profit of the project. Okay, disadvantages. Time value of money is not considered. Inflation rate is not considered. Cash flow beyond the payback period are not considered. We only consider how soon we will recover the initial investment. After that, we don't consider the cash flow, right? After 3 years or after 3 years, 9 months, we don't consider the cash flow. We don't consider the cash flow. And then the second method now. Now second method. ARR. ARR. The second method. ARR is the very easy. Out of all three, this is the easiest one to calculate and do everything. This method considers the rate of return for the investment. Rate of return means the profit, okay? Profit, rate of return. The net profit of the investment only it will consider. In this method, cash flows and time value of money are not considered. In ARR, we don't consider cash flow and in time value, inflation rate, we don't consider. Only the profit for the period, profit after tax is considered. Only the profit after tax is considered. And there are three equations to remember. Now remember, okay, now you need to remember. The equations you need to by heart, you need to remember. Because these will not be given in your exam. What is the equation to find ARR? Average rate of return, ARR. How will you find this? Average net profit after tax divided by average investment multiply by 100. You give it in percentage. This is important. This is important. Average net profit after tax divide by average investment into 100. Okay, now this is the main equation. Now, how will you find the average net profit after tax? How will you find the average net profit? That is the second equation you need to remember. How will you find the average net profit? Total profit for the lifetime divided by number of years. Now, let's say if the project is 5 years, you will add all the total profit for all the 5 years. You will take the total profit of 5 years, all the 5 years. You will add everything and then divide by 5. Okay, average net profit. And then average investment, the third one. How will you calculate average investment? Initial investment plus scrap value. Initial investment plus residual value. Divide by 2. You add the initial investment. Initial investment means, guys, year zero investment plus the scrap value and divide by 2. That's all. So you need to remember this equation. I'll give you 1 minute, guys. Quickly write down this in your paper. If you write down, you will remember. I'll give you 1 minute because we have to do an example now. Then you need this equation. So when you write, you will remember. I'll give you 30 seconds quickly, guys. Okay, now, okay, done now, everyone done now? Right, now for the example. For the example. Okay, now you do this on your own. Okay, guys. So now I hope you are calculated. This is ARR. Only this. Nothing more. Very easy than payback period. Very easier than payback method. Okay, this is the answer. This is the answer. Now calculate guys where we have went wrong. Okay, so ARR is 71.43%. 71.43%. Now tell me guys, using your general knowledge, what would be the decision criteria? What would be the decision criteria? Send your answers in the chat. What would be the decision criteria in your knowledge? Let's see. No, decision criteria. What is your decision criteria? Decision criteria. What would be your decision criteria? Think for yourself, and if you know the answer, send me. Okay, I am receiving the answers, guys. Accept the project or acceptable, and then not to purchase. Answer like this. Okay, can purchase. Now, how can you say can purchase or accept the project or reject the project? Accept the project or reject the project. How can you say by this? Huh? Oh, you will say to accept or reject by comparing, right? This is only one. This is only one machine. You need to compare both, and then only you need to accept or reject. We cannot determine. Correct answer. We cannot determine. What should be the decision criteria? The decision criteria, guys, if there is if there is project more than one, let's say there are two projects, we should select the highest ARR. The highest ARR should be selected when comparing two projects. In payback period, lowest payback period project should be accepted. In ARR, the highest ARR, the highest percentage project should be considered. Well, included, but not. Okay, decision criteria. Wait, I included. No. In ARR, decision criteria, guys, the highest ARR should be selected. Highest ARR should be selected. Now you need to remember that. Okay, you need to remember. And then now advantages and disadvantages of ARR. Advantages and disadvantages of ARR. Okay, advantages. Read for yourself, guys. Read. Okay, so advantages and disadvantages. I mean, this will be tested in part one. Okay, and then net present value. Net present value, the third method. Net present value. Now this is the third method we are going to learn. We have learned two, payback period and ARR. Those are easy. Same thing here applied here. It's very easy to calculate. First point is the most important, highlighted. This is the best method to appraise the project as it considers the time value of money. This is the best method to appraise a project as it considers the time value of money. Inflation rate is considered. Now, if someone asks you, out of the three methods, payback period, ARR, NPV, if they ask what is the best method to appraise a project, you should say NPV, the net present value. Why do you say that? You should answer because NPV method, it undertakes the inflation rate. The time value of money is considered. Only in NPV, time value of money is considered. Okay. This is also very easy. Only 4 steps to be followed. Only 4 steps to be followed. Now NPV, what is NPV? We will learn everything. Now There are 4 steps to be followed. Sorry, guys, due to the wind. Okay, extremely sorry due to the wind sound. Now, there are 4 steps to be followed to calculate the net present value. Number 1, calculate the cash flows. Number 1 is calculate cash flows from year 0, year 1. What we did, we need to calculate the cash flow. Number 2, calculate net cash flows. How do you calculate net cash flows? Cash inflow minus cash outflow. Okay, cash inflow minus cash outflow. Cash inflow minus cash outflow. These are the calculate net cash flows. Third one, calculate net present value. Calculate net present value. How do you calculate the net? How do you calculate the present value? Sorry, third one is calculate the present value. Okay, third step is a new one. What we are doing right now is a new one. What is meant by present value? Okay, the equation I have given, present value equal net cash flow multiplied by discounting factor. Okay, net cash flow multiplied by discounting factor. Okay, what's meant by discounting factor? Discounting factor means, guys, we take it as inflation rate. Okay, we take it as inflation rate. Now, discounting factor, we will learn the example, you will easily understand. And the present value, I'll explain. But remember the 4 steps. Fourth one is calculate net present value. Calculate net present value. Equation, net present value equal present value minus initial investment. Okay, initial investment means at year 0, right? Year 0, initial investment. Now, these 4 steps, all these steps are interconnected. All these steps are interconnected. To do step number 2, you should do number 1. For step number 3, step number 2 is important. To step number 4, step number 3 is really important. Now imagine in your hurry, without reading the question, you did a mistake in step number 1. If you did a mistake in step number 1, your final answer will be wrong. Your final answer will be wrong. So you need to be really good to do this question. Now these are easy, but follow the steps. Okay, let's learn now. What is meant by time value of money? All this time I am saying, what is time value of money? Let's learn now. The value of money which is received today, is higher than the value of money which will be received in the future. Is identified as time value of money. Okay. The time value of money changes due to interest or investment cost. Now simply in economics we learn interest rates is the price of money, right? If interest rates increases, value for the demand for money reduces. And vice versa. Simply, last sentence, simply explained, due to inflation, the value of money decreases over the period of time. Due to inflation, the value of money decreases over the period of time. This is what you need to understand. Okay. Example, the value of rupees 100 today will be rupees 120 next year. the value of money has reduced due to inflation. For an example, in practical, let's say if I have 100 rupees, okay, if I have 100 rupees, let's say in 2015, before 6 years, right? 2015, if I have 100 rupees, I can buy two coconuts. I can buy two coconuts. But now I can only buy one, even not one. Okay, let's say one, only one, which is 80 or 90. I can buy only one. So what has happened to the currency value of 100 rupees? The value has reduced, right? The power of 100 rupees has reduced. Why? Because of inflation, prices of goods have increased. So that is time value of money. Calculating time value of money is really important because in every economy, inflation exists. And as the business is intending to invest a large amount of money for a longer period of time, calculations should be done. Now, in business perspective, inflation should be considered. Inflation rate of the economy should be considered. Okay, why inflation rate is really important? Inflation rate is important to calculate the present value. Inflation rate is important to calculate the present value. Okay, sorry if it's lagging. Okay, now let's learn present value. Now, in the previous slide, I explained the time value of money, right? In the previous slide, I explained time value. Now this is a last slide for today. I hope to cover until this. That's all. Now, present value. Present value means identified as today's value of future cash flows. Today's value of future cash flows. Present value. To calculate present value only, we need inflation. The discount, the time value of money is required to calculate the present value. Present value means, guys, if I receive 100,000 after 4 years, what is the value? That means in 2025. If I receive 100,000 in 2025, what is the value of that in today's term? That is present value. Okay. Present value of money is calculated by discounting the future net cash flows using the discounting factor. Okay, very simple English, right? You should discount, let's say you should multiply the future net cash flows by discounting factor. Multiply future net cash flows, multiply by discounting factor, you will get present value. Okay, last, it means calculating the future cash flows in today's term. Discounting value table will help you. Do we need to calculate the discounting values? No, it will be given in your exam paper. In your question, they will give you the discounting value table, they will give you. Okay, third one, year zero represents today, right? Now, from start, I have been saying year zero means today. Discounting factors will be given at the exam. Discounting factors will be given at the exam. Okay, a simple example now. A simple example like this only you will get. Let's say now this is the project, right? Now there are 3 years. The project is 3 years. That's why there is 1, 2, 3 until year 3. Year 0 is today now. So year 3, right? Now today I will invest 100,000. Today I will invest 100,000. Then after 1 year I will receive 20,000. After 2 years I will receive 35,000. Now you see the amount sign positive, right? Not in negative. And then wait guys, I will now I will explain present value and future value right now, then you will easily understand, right? Then after 3 years, I will receive 50,000. After 3 years, I will receive 50,000. Now you see the cash flows given are the future values, right? That rupees 20,000 is after 1 year. That means in 2022, that is a future value. Year 2 means after 2 years, I will receive 35,000. Year 3 means after 3 years, I will receive 50,000. Now this is the future cash flows which I will receive because of this project. Now, if you look at discounting factor at 10%, we are 10% means inflation rate is 10% or interest rate is 10%. Like let's say inflation rate is 10%. So today 1 rupee is 1 rupee. No, today's 1 rupee is 1 rupee. But look at the discounting factor, guys. After 1 year, the value of 1 rupee is now 0.909. Understand very well, okay? Very general knowledge. Today 1 rupee. Now today 1 rupee is 1 rupee. Exactly. Okay, today 1 rupee is 1 rupee. But today 1 rupee after 1 year is 0.909. The value has increased or decreased. The value of 1 rupee has increased or decreased. In your answers, guys, if you I can easily understand. Okay, decreased. Okay, then after 2 years, the value of 1 rupee is 0.826. Now you guys know year 0 means today. Year 0 means today. Now today 100 rupees, today 100 rupee worth. But after 1 year, it will be, the value will be reduced. Something like that only we are doing now. So today 1 rupee after 3 years is 0.751. You need to understand what is meant by discounting factor. You need to know that. There are students who will do investment appraisal very well. But if you ask this, the technical terms, okay, why are you multiplying? Why are you multiplying by discounting factor? What are those 0.909, 0.8? What are those? Then they won't explain. They cannot explain because they are like a bookworms. They only by heart and do something like that. Understand accounts. Very easy. Okay, discounting factor now done. Okay, how will you now calculate the present value? Present value. This is the last slide. Okay, this is the last slide. You are there until 2 hours. Just be there, then learn. How will you calculate the present value? Multiply cash flows by discounting factor. That's all. Multiply the cash flows by discounting factor. Then you will get the present value. Now, quickly, guys, in your off sheet, quickly calculate. Guys, in your off sheet. Guys, a student has asked me what is the formula for calculating discounting factor. Guys, discounting factor will be given in your exam. We will do past papers, then you will easily understand. Discounting factors will be given in your exam, that 0.909, 0.826 will be given in your exam. In your question, there it will be there. We don't need to find it. Okay. Now present value. Present values. Anyone? Now today's 100,000 is 100,000. But after year 1, I am receiving how much? 20,000. If I multiply it by 0.909, I will receive only 18,180. 18,180. Now what does this mean? Okay, I'll explain now. For year 2, check, guys. Year 2 also check. After this done, after this 208,910, 0.751 into 50,000. It will be 37,550. Sorry. Okay, now what does this mean? Now what does this mean? This means, guys, if you look at year one, after 1 year, I will receive 20,000, right? The future cash flow is 20,000. But I will receive it after 1 year. I need to know what is the value of that 20,000 in today terms. After 1 year, I will receive 20,000. But that 20,000 in today's term is 18,180. 18,180. That is the today's value. And then after 2 years, I will receive 35,000, the cash flow, the future cash flow. I will receive 35,000. But that is after 2 years. That means in 2023, I will receive it 2023. But in 2021, that value equals for 28,910. 28,910. In 2024, I will receive 50,000. But in today's term, that 50,000 equals to 37,550. 37,550. Now, this is the present value. These are present value. Is it easy to understand or not? Just tell me. If you have any doubts, please ask me. After this is done, today's session is done. How can you calculate the NPV? If you can find the NPV, how will you find the NPV? Present value. You take the total of present value minus 100,000 and you add everything. Then you will find the net present value. Net present value means, you guys know, net means addition subtraction. Net present value minus 100,000 and plus everything. Plus everything. That is the net present value. Now we will learn net present value in the next slide tomorrow. But now this is what you need to know. Present value, discounting factor. This is what you need to understand. These are the easy things, easy chapters in this. Do you understand or not, guys? Very easy. Just tell me. Okay, if you have any doubts, what we have learned today, send a message. If you have any doubts, there are some things I need to. If you have any doubts, quickly tell me, guys. If you have any doubts, ask me. And tomorrow, if you need to know what we will learn tomorrow, we will learn decision based on NPV method. What are the criteria? And then advantages and disadvantages tomorrow session, okay? And then format of NPV. This is the format of NPV. And we will do 3 past papers. We will do 3 past paper questions. So have your past papers near to. You will do 3 past paper questions for your understanding. Okay, if you have any doubts, please ask. Please ask. Okay, a student has asked for ARR. So if initial investment not given, we should just divide residual value by 2. No, guy, no. For ARR, initial investment will be given. For all the 3 methods, initial investment is really important. If year 0, without investing, will you have a residual value? Can you earn profit without earning? No. Okay. If you didn't understand, just let us send me a message. Then I will explain it to you more further. Until today, if you have any doubts, ask me, guys. If you have any doubts, please ask me. Send me a chat. Now tomorrow also we have from 7:30. Tomorrow also we'll start from 7:30 and 9:30. Please have your past papers. Please have your past papers nearby, and a pen, and then your working book. Okay, we will do some questions. We will do some questions, and this session recording will be provided after. That means after I have done the tomorrow session. Okay, after I have done the tomorrow session. both sessions will be recorded and then shared simultaneously. That means the same time. Okay, not differently. It was same. Okay. Okay, guys, that's all. So study well, guys. This is very easy method. Easy methods. Okay, easy methods. Easy chapter for you are 10 marks. Another 3 months to go. Another 3 months to go, guys. You need to study a lot. Okay, you need to study a lot. That means to get 3 years. Everyone need to get 3 years. No one need to have 3 W's, right? Try to study. And that's all, guys. Let's meet tomorrow. And tomorrow is a compulsory session, no important session. Try to join. Try to inform your friends who are weak too. Try to inform your friends and get them to. Okay, and by the way, I would like to thank on behalf of Muslim Majlis for providing this opportunity to teach you guys. So this is a humble honor. From our university only they organize this program. So on behalf of them, really thank you all. Thank you all for joining today, and stay safe. Join tomorrow, guys. Study well. Okay, thank you.
Thank you, Brother Wasim. We hope the session was indeed so productive. More educational webinars and motivational sessions will happen in future, which will surely support you in various ways. You can access our YouTube channel if you missed previous webinars. And please feel free to contact us if you want to leave any suggestion or comments based on these sessions. Stay connected with us for more updates. Once again, thank you for joining us and keep working hard to reach your goals. Muslim Majlis of University of Sri Jayawardhanapura genuinely wish all of you for a successful future. Stay safe and have a fabulous week ahead. Thank you.